Hello everyone, welcome to ClearTax Talks. I am Shweta Rungta, Senior CA here at ClearTax. So today I'll be talking about the basics of tax saving. I'll be discussing about what is tax saving, how to do tax saving, when are you required to do tax saving, and what are the different types of tax savings. So what is tax saving? Now tax saving is something that reduces your tax liability. Who all are required to do tax saving? Now, any taxpayer, be it you, me, or any person who has an income above rupees 2.5 lakhs is required to do tax saving in order to reduce their tax liability. So, you can reduce your income tax liability by investing in various tax saving instruments. So, now we'll be discussing about when are you required to do tax saving. I have seen that many people start planning about their tax saving when they receive income tax proof submission forms from their employer. But friends, this is not the right time. You should start from the beginning of the financial year. Here at ClearTax, we saw many people investing in ELSS funds at the end of the financial year. But the correct way to invest in tax saving instruments is the earlier the better. This gives you time to think about the tax saving instruments and plan your savings and then invest it. So people, don't wait till March. Start investing now. If you have any questions regarding tax saving, please leave a comment below and we will get back to you. Let's discuss about how to do tax saving. First of all, you should determine your financial goals and then you should evaluate the various options of tax saving instruments. Once you have determined your time horizon of investment and your risk appetite, you can choose the tax saving instruments that suits you the best and then start investing. Now let's discuss about the different types of tax saving instruments that's there. You might be already knowing about a lot of them, for example, tax saver FDs, LIC premium, ELSS mutual funds, public provident fund, and there are various of them. You can find a list of various tax saving instruments below and choose from there. Now let's discuss about Section 80C. One can invest up to rupees 1,50,000 under Section 80C and can get deduction from gross total income. One can also invest beyond Section 80C and get an additional tax saving benefit by investing in instruments like National Pension Scheme, Home Loan, and other various instruments. So you can invest in any of the tax saving instruments and save your taxes. Now I'll tell you about the house rent allowance exemption and the maximum benefit then you can get from it. If you are a salaried person and you are paying rent, then you can claim house rent allowance exemption. In order to claim this exemption, you have to submit your rent receipts to your employer. Please make sure that your salary consists of HRA component. Friends, I would like to tell you about one hack. I have seen that many salaried individuals, they stay with their parents and so they can't claim the HRA exemption. But there is a loophole. You can pay rent to your parents and for the same amount you can claim exemption, provided that your parents have to show that income in their income tax returns and they should be the owner of the house. If by any chance your salary does not consist of the HRA component, then also you can claim this deduction under Section 80GG. Friends, let's talk about housing loan. So if you have taken a housing loan, then you can get deduction of the entire amount paid by you. The principal component that you pay is allowed as deduction under Section 80C and the interest component paid by you is allowed as deduction under Section 24B under income from house property. Even if one is claiming deduction for housing loan, they can still claim HRA. So friends, apart from Section 80C deductions, you can also get an additional benefit under Section 80D. The maximum amount that is allowed under Section 80D is rupees 25,000 for self, spouse and dependent children. You get an additional benefit of rupees 25,000 for health insurance paid for parents. In case the age of your parents is 60 years or above, then the maximum amount of deduction allowed is rupees 50,000. If both the taxpayer as well as parents are of the age 60 years or above, then you can claim a maximum deduction of rupees 1 lakh. Now, senior citizens and very senior citizens who don't have medical insurance policies, they can get a deduction under Section 80D for medical expenditure incurred by them up to rupees 50,000. So friends, that's it on basics of tax saving. Now I'll be answering the top 3 questions that I get from our customers regarding basics of tax saving. The first one is, what is ELSS and how much can they invest in ELSS? ELSS is Equity Linked Savings Scheme. It is a type of equity mutual fund. You can invest up to rupees 1,50,000 under ELSS under Section 80C. ELSS has a lock-in period of 3 years. Now let's move on to the next question. The next question is, if you invest in FD, the interest received on FD is taxable or not? Whatever you invest in tax saver FD is tax-free. You get deduction for same under Section 80C, but the interest that you receive on FD is taxable. Now let's move on to the third question. So the customers ask, do they have to give the PAN of the landlord to their employer? Friends, it is not required to give PAN of your landlord to your employer if your annual rent does not exceed rupees 1 lakh. So if your annual rent increases rupees 1 lakh, then you have to submit the PAN of your landlord to your employer. That's it on the questions. If you have any further questions, then please leave a comment below and we'll get back to you later. Thanks a lot, friends, for joining this session. Next week, I'll be talking about the benefits of tax saving. So I'm Shweta from ClearTax, signing off. Bye.